Hey guys, it's Nick, and everywhere I turn, I seem to be seeing people talking about SPACs. Nikola Motors SPACs, DraftKings SPAC, all these open door SPAC, all this stuff. And to add even more interest, this article just came out a few days ago. Alec Gores turns $25,000 into $80 million in his SPAC in just a couple of months. So if you think you will watch this video and be able to turn $25,000 into $80 million, you might as well turn it off right now. But if you want to know more about how SPACs work and with some kind of simple examples to make things as easy as possible to understand, check out this video. Now, to show you just how popular SPACs have become, in 2009, there was only one of them for $36 million. 2010, there were 7 of them for almost $500 million with an average of $70 million per IPO. Now, 2020, there's already 106 of them with $41 billion in gross proceeds with the average IPO size of $400 million almost. Historically, when you thought of a reverse merger into a shell company, you thought of penny stock scams and pump and dump frauds like this article here, where the SEC delisted 379 shell companies to keep them out of the hands of pump and dump fraudsters. But things have gotten a lot more respectable with the SPACs. And so these SPACs are not using previous companies that were operating. They're getting fresh new shell companies in an IPO. So to simplify this whole example, let's take the IPO. So let's say that the IPO is the food company that sells the food out of this truck, but the truck is the public listing, meaning the permits you have to get, the registration, the vendor's license and all that, that's like registering with the SEC. And the food being sold by the company is the company itself. So you put those two together and you have a company going public, like say Chipotle Mexican Grill, right? The SPAC, on the other hand, is only the truck without the company selling any food. So it's just the license, just the listing, the SEC listing to be a public company, and they raise a bunch of money doing that without actually having a company to sell any food. Now, the food vendor over here is a guy that's just a private company. He's not public. He doesn't sell, he doesn't have any stock on the stock exchange. He's just a private company. He wants to merge with this truck and become this. Okay, so private equity normally buys private companies, and they don't just buy one. So they may buy a food company and an industrial company and a technology company and a software company all together. Whereas a SPAC, they do their IPO, they raise the money, right? So they have the vehicle, but they don't have the food vendor yet. So they're looking to buy one of these guys and merge them together with their vehicle, their public listing, so that they can become this, the company that has the public listing together. Now the question is, why should you do a SPAC and get the truck and then go look for the hot dog vendor when you could just do the IPO? For a couple of reasons. One, if this hot dog vendor wants to go public, it may take him a lot longer to do it this way than doing it through the SPAC. And also, if he's going to go public himself, he has to go to the roadshow and answer all kinds of questions that he may not want to answer, like how much is your revenue? Have you ever gotten fined by the Department of Health for selling bad food? What kind of ingredients do you use? All kinds of stuff like that. So he may not want to answer all those questions and come under scrutiny of the SEC. So they do it this way, as kind of a backdoor way of doing it. So now the SPAC wants to raise $100 million for their blank food truck, all right, their shell listing, and then they will go look for a company to plaster on the side here their logo and get equipment and start selling food out of this truck, right? So how do they do that? So they say, we're going to do $100 million. Now, most of the time, the sponsors, the people that are doing the SPAC, have a specialty expertise. So say the guys that did the Nikola Motors, they have backgrounds at GM and that kind of thing. So generally, let's say in this case, the guy doing this food truck SPAC, let's say, not that you're going to do one for a food truck, but he would have experience in the restaurant business, let's say, or food service business or something along those lines. So he would say, okay, this is the deal. We're going to sell units, and the units consist of a common stock at $10 a share. Why $10 a share? No particular reason, but that's what most of them do, around $10 a share, although Bill Ackman's new SPAC is $20 a share. But the reasoning is probably something along the lines of this. If they did $5 a share, it would sound too cheap and it would make them, in the range of a penny stock, and people are wary of that and it may be scammy. However, if they did it too expensive, right? So at $10 a share, $100 million, that's 10 million shares, right? But they also could have said, hey, we're going to do it at $100 a share and just do 1 million shares. It's the same thing, $100 million. But smaller retail investors may be happy to buy it at $10 a share because they go, oh, if it just goes up to $20, I'll double my money. But if it's at $100 a share, even though it's the same exact thing, people will think that it's too expensive and it has to go up too much for them to make money or something like that. So it's a psychological thing, really. So along with that unit is the common stock, but also a warrant. And so what a warrant is kind of like a lottery ticket or a call option. So usually for every share that you have, you get half of a warrant. So let's say you have you buy $10,000 worth, you buy 1,000 shares, you'll get 500 warrants at $11.50. And what that means is, if the common stock goes up above $11.50, then you will make money because you have the right to buy more stock. You have the right to buy, say, 500 more shares at $11.50. And so obviously this will only be profitable if the stock goes above $11.50. But you have usually multiple years that the warrant is good for, that you can exercise it. So it's like an extra little sweetener to the deal, a little kicker to the deal of buying this SPAC. So here are some terms that most SPACs follow generally. Once they do the IPO, they have 2 years to find a company to purchase. Otherwise, they have to give back the money to the people that bought the IPO. Now, this almost never happens because the sponsors of the SPAC are incentivized to find a company because of their promote shares or their founder shares, which is like a 20% cut of whatever deal they get. Okay, so this is where they make their money, really. Now, after the IPO, the cash sits in like escrow in short-term treasuries, gaining some interest. So if you buy the stock at $10 in the IPO, after a year or so, the stock may be worth, $10 and change because it gained some interest in the meantime. Now, when the SPAC finds a company to buy, the stockholders have to vote on the purchase, and they could vote no and get their money back, or they can even vote yes on the purchase and still ask for their money back. Why would they do that? Because they can get they will get their money back plus whatever prorated interest that has accrued, and they can still keep their warrants. Now, when you buy a unit, which is the stock, the common stock, and the warrants, after like 50 or 60 days, the unit splits into two, into the stock and the warrants. So you can redeem your stock. You can say, hey, buy back my stock for my $10 plus whatever accrued interest I got, but I'm going to hold on to these warrants as like a little lottery ticket. Or you can even sell the warrants and make a couple extra dollars, increase your percentage if you just want to cash out before they buy the deal because you don't like the deal. So there's money to be made on SPACs, even if a deal is never made, really. But like I said, because of the promote shares that the SPAC sponsors get, they are highly incentivized to find a deal, even if it's not the greatest deal, because they get 20% of the deal. Okay, so that headline about Alec Gores turning 25,000 into 80 million, that's because he gets to buy 25,000 shares in the SPAC, $25,000 in the SPAC at a price of like 0.2 of a penny, while the retail guys are paying $10 a share. So his 0.6% of the company on a $16 billion valuation comes out to like $96 million. Now him and his managers did put in like $10 million or so at risk for the registration and other expenses. So, but net, he's going to walk away with like $80 million for putting in that $25,000. So this is where they really make their money, on that 20% there. So now you have your $100 million shell company that's publicly listed, right? You got your blank food truck here with $100 million in cash in it. And now you're driving all around the cities and the country, and you're looking for some kind of food company to buy to merge into your food truck so you can become a publicly listed food truck company, let's say, right? So you're driving around and you got 2 years to do this. Now, the thing is that sometimes they're not really looking for a company to buy, meaning they already know what company they're going to buy. So sometimes the company knows that they want to do a SPAC, and they get in touch with the people that do the SPAC and prearrange the SPAC to happen so that they can kind of do this backdoor IPO without spending so much time doing it the regular way. So not all of these SPACs are really looking for a company. Sometimes they already have one in mind and the deal is already pretty much set. So that's how it works a lot of times. And that's why some of these founders that are in the same business, they might have left a company that they had an idea or something, some kind of spin-off, and so they went and found some SPAC partners or started a SPAC only to buy this specific company. So now let's say after driving around for whatever, 6 months, a year, you finally found your great target company, this guy selling hot dogs over here on Times Square, and he has some kind of, gourmet hot dogs that's going to revolutionize the whole food industry, and hot dogs are the hot ticket right now. They're like the electric cars of the food industry or something like that, but his price tag is $200 million. Well, for one thing, why are you paying $100 million for the IPO and giving the SPAC sponsors 20%? Well, the reason you're doing that is because they have expertise in the food industry, let's say, And so they're saying, yeah, you're giving us $100 million, but we're going to find a deal that's $100 million, but it's really worth more than $120 million. Meaning, yeah, we're charging you 20% more, but it's worth it because we have experience, we have the management to help run and expand the business or whatever. So our value is going to bring a company that's worth more than $120 million. So it's really costing you nothing to put in this $100 million and give us our 20% because you're going to get more than that back. So that's what the pitch is, because a normal IPO, the underwriters only take somewhere between like 4 to 7% of the IPO or something like that. So why are these guys taking 20%? Because they say they bring the value of the industry and the management team that can help grow the business and all that kind of stuff. So, but this guy says he wants 200 million and your SPAC is only for 100 million, right? What are you going to do? Well, normally most of the SPACs that do their IPO, they don't really look for a company that's the same size of their IPO. They look for one that's bigger. Okay, so how do they buy this $200 million hot dog stand if they only have $100 million in their blank food truck? What they do is they usually get outside investors to invest more. $100 million purchase price. The SPAC only has $100 million. So what they'll do is they'll get a mutual fund or a hedge fund or somebody, investment private equity, to do $100 million, let's say, in a PIPE, which is a private investment in a public equity. And what that is basically saying is they go find a hedge fund or somebody and they say, hey, look, we got this great hot dog deal here. It's 200 million. We have 100 million. We need another 100 million. And the PIPE will say, okay, we'll give you 100 million. Your investors bought in at $10 a share. We want to buy in at some kind of discount, maybe $9 a share, maybe $8.50 or something like that, because they're putting the whole 100 million in one piece. So they're getting a discount right off the bat on the price of the share. So that's why it's attractive to them. And why is it attractive to the people that sponsor, that do the SPAC? Because their deal is getting bigger and they're getting 20% of whatever the deal is. So if the deal was only 100 million, they'd only get 20% on top of that. But if the deal is 200 million, now they're getting 20% of 200 million. So the bigger the deal, the better it is for the sponsors. So that's why, even though they only do 100 million in the SPAC, they can do a 200, 300, 400 million dollar deal because it's in their best interest to do so, and they can do it through a PIPE or some other debt or something like that. So here's kind of the selling point of the SPAC. Basically, what they're saying is, look, you take our blank food truck, our publicly listed blank food truck with $200 million in the back here. We add it to this hot dog guy. We give him 200 million. He gives us his hot dog thing. But even though that's probably the simplest way to think about it, they try to give out as little cash as possible. So they may say, look, we'll give you some cash for your hot dog truck, but we'll also give you stock so that you're part of the investors now in this, and in the hopes that we can grow this a lot bigger. And now the SPACs only have to buy up to around 80% of what they take in. So that 100 million they took in, they have to buy something at least $80 million or so. But they can keep the rest as kind of a cushion to help grow the business. Okay, so you're the hot dog guy. You're saying, look, I'm getting a listing, but I'm also getting a cushion of, say, 20 million or some other money in there to help me grow the business. So I turn out to be not just this hot dog guy on the corner, but now this super JoJo's Grilla Dog, whatever, gourmet hot dogs or vegan hot dogs or whatever the hell the trend is. And you're going to grow the business with the help of these SPAC guys who are also restaurant industry type of guys. So they will help you out. So this plus this equals this. So it's like 2 + 2 = 6 kind of thing, or at least that's what they're trying to sell the investors on the SPAC. You give us your money, we'll get the IPO. With our experience, we'll find a really great deal. We'll put that deal together with this, and we'll come up with something even bigger and better, and we all make a whole lot of money, and everybody's really happy. So does that happen all the time? No. Does it happen sometimes? Definitely. Does it happen more than in IPOs? That's debatable. The track record for SPACs is I think a little less than for regular IPOs. So take it with a grain of salt and really look at these deals and see what the sponsors are getting out of it. And you look at this Nikola deal, and now the sponsors are getting sued because they didn't do their due diligence, they're alleging, and things like that. So just because the sponsor has experience in the industry doesn't mean they're picking a good deal. And think about it. If you're the sponsor and you got $200 million burning a hole in your pocket, or $100 million, and in 2 years, that's going to all go back to the shareholders. Whatever extra money you had to put in for the IPO listing and all that kind of registrations and all that, you're going to lose it if you have to give back the money to the investors. So 20% of a crappy hot dog stand deal, where you get 20% of whatever the number is better than holding out for a great deal and maybe not finding it and having to give all the money back and losing out the money you put up for the registration and all that. So in other words, 20% of a mediocre deal is better than 0% of no deal. So think about that the next time you're investing in a SPAC and they come up with a deal, because it may not be the greatest deal. They may be influenced to do it just because time is running out. Who knows? So that's my look at SPACs and kind of a simple way of looking at it versus IPOs. If you like this video, please give me a thumbs up for the YouTube algorithm, and share it and subscribe if you haven't subscribed yet. And thanks for watching.